Hello everybody, it's Tom Sheridan and Chris Darbyshire once again. And now we're looking forward to yet another year, 2016. Chris, we had several things happening in 2015 which will have repercussions for years to come. We had Greece, which we've probably all forgotten now. China was probably a much bigger story. Commodity prices were certainly a big story. And of course, the Fed. Major topics will influence the portfolios, particularly commodities and the Fed going forward. In terms of the scenarios that we paint for our clients and for the portfolios and the economic backdrop, what does the committee think 2016 is looking like?
So 2016 is looking a bit like 2015, except I think there are two main differences. First of all, I think people are more confident on Europe than they were going into 2015. And secondly, they're a bit less confident on the US than they were. So people have sort of bumped down their expectations for the US. They've assumed Europe will continue on a pretty good trajectory, which is what it's on. But I think my real takeaway from the committee was that we're quite certain of those outcomes now. So we have maybe a slightly more lukewarm environment, but greater certainty. We're more comfortable that we're going to be right on that.
Well, that's good comment on the U.S. and Europe. Emerging markets played a big part in 2015, and in particular, the prospect of the Fed raising rates and possibly another taper tantrum in emerging markets. And we certainly saw a divergence between the commodity producers and the commodity consumers. What do we think emerging markets holds in 2016?
Yeah, so I think emerging markets had a real currency problem this year. That was the biggest impact. They didn't have a great markets weren't great, but the currencies were particularly weak. And it was as if the fears about commodities and the low oil price for the exporting nation seemed to infect the whole asset class. So I think going forwards, key question is China. Is China really slowing significantly? Is the government managing the change from manufacturing to services? And we see no reason to think that there's anything to be particularly worried about. Certainly, the fears in the summer have not come through. In fact, if anything, the Chinese economy probably has got more room to surprise on the upside, given how low I think expectations are.
Given the fact that inflation has been quite low, largely as a response to the fall in commodity prices, but not only, we have a case of real and nominal returns, economic activity, which have been distorting some of the views that people have. When they see lower headline numbers that don't translate into lower real numbers, they still get concerned that we have lower real numbers. Now, in China, we have a little picture here, which actually tells a very interesting story.
Yes, this issue of real versus nominal numbers shows up in a number of different areas, and one of them is in China, for example. So people worry about China because China has imported, in nominal terms, 40% less oil this year than it imported last year. But in real terms, so looking at the numbers of barrels, not the amount you pay, it's importing 9% year-to-date more oil than it did last year. So in the real world, the economy is growing. In the nominal world, it looks like the economy is shrinking. But of course, it's good news for China, spending 40% less on its oil than it did last year.
Indeed. And what we're seeing here is a comparison between China and the United States. And surprisingly, China is adding as much growth to the world as the United States over the last 4 or 5 years. And in real terms, you see that China's growth is actually marginally increasing year on year, not decreasing as the percentage headlines would have us believe.
Yes, so the percentage year-on-year growth comes down, but we would expect that as the economy gets bigger. The actual amount of growth that China creates every year is trending slightly up, but it's not a story of an economy in significant decline.
Chris, you alluded a moment ago to the fact that China is in transition from a manufacturing economy to a services economy led by consumption. And we find that to be a theme that occurs elsewhere, the US and Europe in particular. In this particular slide, what are we looking at? What's that telling you?
So we see a lot of bad manufacturing data at the moment, and it's really been a trend all year. So GDP growth is a bit slower than people would like. The manufacturing sector is maybe flat or even shrinking in some countries rather than growing. Now, a lot of this is to do with the oil industry, which is a big part of manufacturing output. The other aspect is that there isn't a lot of data on services. There's lots of data on manufacturing and not much on services, but services is a far, far bigger part of the economy. So what this chart is showing is, in the US, over the last 18 months, what sector created jobs? And the blue line on the chart is the services sector, which over the last 18 months created about 3.5 million jobs in the US. Contrast that with the manufacturing sector, which is the slightly lighter blue line on the chart, which created jobs but not many. And then you've got the mining and logging sector, the red line on the chart, which lost a few jobs but not many. Bottom line, services matters much more than manufacturing.
And if I have my numbers correctly, the consumer represents about 2/3 of US GDP?
That's correct. It's similar in all developed economies. Now, the consumer in China is a bit less, it's about 55%, but it's moving towards that 2/3 number.
So the bigger of the two is the one that's on the uptick.
Correct, and that's, I think, been one of the big stories of 2015. A year in which we became very certain that the consumer's doing well, wages increasing, lower fuel costs is a good thing.
So having just touched on the real and nominal component to looking at the numbers, deflation. Is deflation a good thing, a bad thing? Is it a threat? Should we be worried?
So that came through very much from the committee meeting as well, that I think it's now unanimous that the kind of deflation we're seeing, which is deflation in commodities, including oil, is a good kind of deflation. It benefits more people than it hurts. Now, markets aren't seeing it that way yet. When the oil price comes down, it drives down the value of energy company stocks, but it also seems to be driving down the stock market as a whole. Now, that doesn't make a lot of sense if you're a company that uses oil as an input.
So we are seeing healthy consumer spending. Is that somewhat because of the lower cost of commodities?
I think that's right. I think once you take out the fact that people are spending less on commodities, you see actually that retail spending, consumer spending is trending upwards quite nicely.
So what's bad deflation then?
Bad deflation is when it hits wages. And that's what we had. We had disinflation in wages post-credit crunch up to about the beginning of 2015, maybe slightly before. And that was a worry because it meant that there was people couldn't spend more money, they didn't have more money to spend. Net, year on year, they were not any wealthier from their income versus their expenditure.
So if I could oversimplify that, if my outgoings cost less, that's good deflation, and if my incomings go down, that's bad deflation.
That's exactly right.
If we carry that thought forward to what is actually happening to consumer spending, what are we seeing here?
So what we're seeing here is UK retail sales volumes and then a higher line, which is growing at a faster rate, which is UK retail sales volumes excluding petrol. And it's back to our conversation about real versus nominal. If you take out the effect of lower energy costs, you can see that retail spending actually is pretty healthy, growing at a reasonable clip.
I'm spotting a theme here.
I think that's right. I think we anticipated coming into 2015 that the oil price decline would be a good thing for consumers. It's been hard to see it in the data though, because the oil price decline has caused the nominal data to come down. You see it in the US very much when you look at US retail sales, where you've got two effects. You've got the oil price, meaning retail sales are lower, but you've got the dollar, meaning things that you import are cheaper, and the US imports a lot. Dollar's been strong. So you see, in nominal terms, you see the US spending the same amount this year, 2015, that they spent last year, 2014. If you undo that and get back to real terms, you see a much more positive sign, actually a very positive sign.
So the real versus nominal issue encompasses not only a fall in commodity prices, but a rise in the value of the dollar.
That's right, and the dollar's been, I think, one of the big stories of the year. rose very strongly in the first 3 months of the year and actually has range traded since. It peaked in March.
We mentioned at the beginning of the broadcast that one of the major events of the year dominated the second half of 2015 was, would they ever raise rates in the U.S.? And we almost got there at the end of Q3, and then they backed off. And of course, as we now know, at the end of Q4, they actually made the move. What's the impact going forward, though?
So it's been a huge focus of attention, which for 25 bits of higher rates, is maybe disproportionate. There's been a huge rise in the dollar, as we mentioned, as a result of this. I think the impact going forwards is much less than people have been expecting. I think in historic terms, this is a drop in the ocean compared to rate rises in the past. I actually think it's a slight positive in that it maybe gets people off of being myopically focused on the rate rise coming and now focused on more normal concerns such as, is the economy growing fast enough to sustain rate rises? Will the rate rises be too fast for the economy? Will they be not enough? Will the economy, get to a higher gear? And will the Fed be behind the curve? These are what I call normal concerns that we've been living with half our lives. We have just forgotten them for the last 8 years.
So one of the things that calls to mind when you have the U.S. raising rates and the rest of the world not raising rates, as a matter of fact, Europe and Japan continuing with their QE programs, this divergence in policy between the U.S. and the other parts of the developed world, is that going to manifest itself in currencies?
Well, it has manifested itself very significantly in currencies up to now. I think the question is, where do we go from here in terms of currency divergence? It looks to me like it's come to the end of the main divergence that we've seen, particularly when the euro bounced very significantly recently on another load of QE, just wasn't quite enough for the markets. And then the yen did a similar thing very recently. More QE announced, didn't satisfy the markets, the yen bounced up. So I think we're seeing the limits of QE now to drive currencies weaker.
So are we looking at 2016 being the end of QE throughout the world?
I think it's not the end of the actual undertaking of QE by central banks, but I think it's the end of markets really focusing on QE as a driver of markets.
Back to the real world.
Back to the real world. And that's where we're positioned for in the portfolios. We're positioned for the real world, which is kind of on a good trajectory, albeit maybe it's not quite as fast as we'd like. I think we've been buffeted a lot by markets this year, not quite liking what they're seeing in the monetary policy world.
So when we look at the events in monetary policy and currencies and interest rates during the course of 2015, the big event that hit all the screens in Q3 was China devaluing its currency. Or did it?
Well, it did devalue. It devalued against the dollar by a few percentage points and against other currencies by more. What I think was remarkable was the reaction of the markets relative to the amount of devaluation. A few percent is neither here nor there. The renminbi, as we can see from the chart, is up 30% over the last 5 years. So you're up 30, down 4. And this is what markets are being driven by today. Very, very sensitive to monetary policy and less sensitive to things like trade surpluses, trade deficits, economic growth rates, which used to be the main drivers. So I think going into 2016, we're hoping we get a bit away from this kind of huge focus on currencies and monetary policy and more back to a normal world, economic growth, trade surpluses and deficits.
So a little bit of weakening in the Chinese currency actually could be a marginal help for China and its growth pattern.
I think currencies should. Currencies can devalue. We've seen the yen devalue by 30% against the dollar, the euro by 20% against the dollar. The dollar devalues as well at times. So for me, a devaluation in the Chinese currency doesn't indicate a crisis.
Looking forward to 2016 then, we think that we've seen some of the turmoil in markets anticipating what would have happened when the Fed raised rates. And of course, when they did raise rates, it turned out to be a bit anticlimactic. So if we can look at what the new normal looks like, still lower growth, but accompanied with lower inflation, so that real rates of return and real progress in GDP terms, actually not so bad, but on a nominal basis, they don't look so great. They don't look so exciting. So how do we construct portfolios for that kind of a scenario? And how is that construction different from where we've been?
So you have this situation where, because real rates are very low, then bond yields will tend to be very low. Now you may still make a positive real return from bonds, but your margin of error is very narrow. So again, we like equities. You know, equities may be generating 4-5% per annum in nominal terms, but they're close to that in real terms, which is where they've always been. So for us, you know, stay with equities. We still like Europe. We like Japan. We like Japan a little bit less. There, the currency has really stabilised a great deal. It hasn't devalued much against the dollar during the year. And therefore the earnings growth may begin to peter out a bit. We've had, 3 fantastic years from Japanese equities, and we've been overweight that whole time. So we're just beginning to pull back a little bit from triple overweight down to more like a double overweight position.
Right, so a bit of money out of the Japanese equity market. Where are you going to put it?
So we're going to put that allocation into the US market. So keep it in equities, put it into the US market, where we think there's 2 interesting angles. First, the dollar year on year is now basically the same. It's not showing any particular strength. So you should get a little bit of earnings boost coming through there. And secondly, there's still value around in the US. The US stock market's been driven so much by the big growth stocks, the tech stocks, Amazon and Google and so on, that there's quite a large number of sectors that have been left behind in the US that are showing quite decent value. So we think that by switching from Japan into US value, we can actually go down from a 15 times multiple, maybe down to a 13 times multiple.
Sounds sensible to me. In addition to what we're doing in Japan and in the US, what's the position on European equities?
So we're going to maintain the large overweight to European equities. As I said, they've delivered quite well last year. The economy is also delivering quite well. We like that combination. We think that continues for another year. However, within that position, we're going to probably switch out of the larger companies and into smaller companies, more domestically focused. And that's to avoid the impact of the euro year on year not weakening. So you don't get that boost to earnings coming through. So that might impact large cap earnings.
Okay, so a bit more style diversification within Europe in the portfolios. Now, we have had a significant position in Asia outside of Japan for the last couple of years. What's that looking like going forward?
Yeah, so we're going to maintain that position. I think it's really, really important to be invested in China. We think Asia continues to be the most exciting region in the world. Economically, great potential there. A lot of markets that are quite developed, really, still called emerging, but really they're showing signs of being developed. Currency is a bit weaker now, and the exporters in Asia have not had a lot of help from currencies over the past few years. So looking really interesting. And China, it continues to really amaze me. We've now got a big change coming in the China benchmark, which is the inclusion of Alibaba and the big internet companies that are currently listed in the US are moving back into the index. And those companies are desperately keen to list on the A-share market in China, where I think their value is much more appreciated because they're home brands in China.
All right. So 2 years ago, you made a call to move the emerging market position from commodity producers to commodity consumers, which is why we find ourselves largely in Asia as opposed to in the Brazils and the Russias of the world. And that's worked out on a relative basis very well over the last couple of years. Q3 of 2015, everything got hurt. But going forward, we still see that same theme of the benefit to the commodity consumers playing out in Asia.
For now, definitely the political risk in Brazil and South Africa and the sort of non-Asian emerging markets still quite high. Still got the problem with commodities imports versus exporters. So I think, yeah, Asia continues to look interesting now. That's right. It worked on a relative terms. Worked out holding Asia, not holding Brazil, for example. Didn't work out holding Asia. That got hit during the summer. But again, I think it was mainly currencies. We look at the underlying corporate profits doing fine. In fact, very good in some cases.
So that gives us a pretty good picture of where we are on the equity side of the equation in the portfolios. Bit of money out of Japan into U.S. value, a little diversification in style within Europe, maintaining our Asian positions in equities. Now, there's a fixed income portion of the portfolio, and the alternatives portion of the portfolio are at least half of our holdings. What are your thoughts on the fixed interest environment other than what you've already said?
So in fixed income, we are just tweaking our bond positions a little bit. So we're moving some money out of cash and into bonds. And the reason we feel we can do that is that we're quite a lot more confident on the positive side of the equation. So we have a bit more confidence that our equities have got some good upside here. So we don't mind taking a bit of putting an anchor into the portfolios that might drag them back a bit if equities are doing very well, but will help the portfolios a lot then if we have a kind of a sudden sort of risk-off event in the markets.
So a bit of fixed income used to position against, say, geopolitical tail risk, for example. So if we have those 2 or 3 months of high volatility, that you have a buffer within the portfolios.
Yeah, and we've got more of a buffer. You never know what kind of a crisis it's going to be, but we try and put a bit more buffer in the portfolios there. The other thing we're doing is that we're moving from our high yield positions into convertible bonds, particularly in the lower risk portfolios. And the reason there is that the high yield market is very much the epicenter at the moment of market concerns. You've got the energy sector and some defaults coming through there. And you've got some concerns more broadly about liquidity in the high yield market. So convertibles, similar risk profile, a bit more upside, tad more volatility, but we think on a 3 to 12 month view look like a better investment.
And in moving from high yield to convertibles, the sector concentrations shift, don't they?
Yeah, that's a good point. So the high yield sector is about 20% exposed to energy and commodities, whereas that exposure is 5 or 6% in convertibles. They're more tech orientated, more growth orientated.
And how about the alternative section of the portfolios? Now that we know what we're looking at in equities and fixed, alternatives, and then maybe lastly a word on currencies, please.
Yeah, alternatives, we continue to want to do more alternatives. So we've increased the allocations by a couple of percentage points to alternatives. But alternatives are a bit more complicated than normal investments. It takes a bit longer to do due diligence. I'd love to have a big allocation to them, but we're going to increase in baby steps because we want to do our preparation correctly. We want to do our due diligence correctly and get the right investment. After all, alternatives, weren't the panacea during the credit crunch either. So let's do more alternatives, but let's get them right. And then currencies, we're going to maintain our currency positions roughly as they are, which means that we're going to be about half hedged on our euro exposure and about half hedged on our dollar exposure. And that's moving the other way. So we used to be completely hedged on Europe and completely exposed to the dollar, so dollar strength, euro weakness. And now we're kind of preparing for something a bit more in the middle between those two. And at some point during the year, I think there's going to be a period of euro strength and dollar weakness, and we hopefully will then be positioned accordingly then.
And the yen?
So the yen, we've reducing our allocation to Japanese equities will take down some of our yen exposure. We're probably going to take a bit more actual yen exposure within that. So we'll be, at the moment we're going to stay 50% hedged, but we're looking to the yen to become a stronger currency over time.
Chris, thank you very much. Just to re-emphasize, the nature of the 7IM investment program is a medium to long-term investment program. We like equities at this point in the world, but we live in a more volatile environment. And there are liquidity issues as well as geopolitical issues that lie behind some of that. Our word is to stay the course, ride through it. Your customers will need to take some risk to get some return, And the kind of risks that we're taking are diversified, and we're also managing with a little buffer in the portfolios for those uncomfortable months. Chris, thank you very much. Happy New Year to all of you, and I'm very much looking forward to a very successful new year for all your businesses. Thank you.